Opendoor dropped 99% from its all-time high. It was about to get delisted. Then out of nowhere, it nearly 10x'd. Not because of earnings, not because of a new deal, because it became a meme. And here's the crazy part. That kind of move almost never ends the way people think it will. Reddit called it the next Carvana. The stock shot up to nearly $5 and is already back under $2. And now it's stuck in a weird place, right? Part hope, part hype, and no profitability in sight. My name is Rick Orford. I've been trading since 1999. I'm not a financial advisor, but I have seen this kind of hype cycle more times than I can count. So here's the deal as I see it. Revenue's down, losses continue, and Q3 guidance just got slashed by 44%. But it did post its first adjusted EBITDA profit. It's cutting costs, and retail investors, they're still holding for now. So could this be the early sign of a comeback or the calm before another crash? And this begs the question, does Opendoor have a real shot at survival, or is this just GameStop 2.0 without the squeeze? Well, to find out, let's get into it. Okay, so before we talk numbers, let's look at what Opendoor actually does, because the business model is the foundation of the whole story. Opendoor Technologies is a real estate tech company that operates as what they call an iBuyer. iBuyers streamlined the home selling process by directly buying properties from homeowners who post on their platform, of course, after a couple of assessments. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/ricko to get your 10 stock picks right now. It then performs any necessary repairs and then resells the properties. So it's kind of like a house flip, but on a much bigger scale and powered by algorithmic pricing models. The company also offers services like real estate brokerage, title and escrow processing, and property insurance. 2020 was a different time, and when the company went public, there was a lot of buzz around its business. We had zero interest rates, a red-hot housing market, and strong investor interest in anything tech-related, and that worked well for Opendoor's stock price. But here's what I've learned. Hype and favorable conditions can launch you fast, but they can't keep you in the air forever. Now, here's where this story really starts to get wild, because the chart looks a little bit like a roller coaster designed by Elon Musk after 3 espressos. Now, let's go over Opendoor's stock price, right? And if you want to follow along, just go ahead and scan this QR code. Opendoor went public through a special purpose acquisition company merger, and its first official date of trading as its current business was December 21st, 2020, at around $31 per share, and reached a peak of $39.24. Since then, the stock experienced massive volatility in its first year, followed by a downward spiral that ended at 51 cents on June 26, 2025. And that's almost 99% off of its all-time high, putting the company at risk of delisting. Stocks listed on the NASDAQ are required to trade over $1 among other things. Should a stock fall below $1 for 30 consecutive trading days, NASDAQ sends a notice of deficiency. Then, the company enters what's called a 180-day compliance period, where the stock needs to trade above $1 for 10 consecutive days at any time within that window. For reference, Opendoor dipped and stayed below $1 on April 23rd. And it should still be in the middle of its compliance period today, but then something changed. And that's something where this story takes a sharp left turn. On July 1st, the stock began to climb, surpassing the dollar requirement and reaching a new high of $4.97 a few days later, though today it's already back down to about $1.85. Now, you might be wondering, what caused it to skyrocket that fast? Well, did the company report any record-breaking financials? Did it partner with a big tech company for a major strategic deal? Well, not exactly. Many financial news outlets report that Opendoor reached what we call meme stock status, similar to GameStop, AMC, and BlackBerry. For those unfamiliar, a meme stock is a stock that suddenly surges in popularity with retail investors, causing sharp price movements. Meme stocks at their heights are often featured in social media like Twitter, TikTok, or Wall Street Bets on Reddit, which is where the GameStop short squeeze started. And let me tell you, some posts that are supporting these stocks aren't your usual go buy this threads. There's actual serious research, or DD, and discussion around meme stocks right there. I mean, deep dives, insider ownership analysis, technical setups, industry studies, and more, all to justify why they're kind of setting up this stock to go up like it's the next big thing. But here's the truth. Meme stocks move high and move up fast, but they rarely, if ever, have the fundamentals to back up the price move. So eventually, when the internet's notoriously short attention spans kick in, meme stocks tend to crash hard. So you could say they're kind of like financial fireworks. Spectacular for a moment, then poof, gone up in smoke. Well, we saw this in all of the examples I mentioned earlier, but is this the case with Opendoor? Well, to find out, let's have a look at the financials. Opendoor recently released its second quarter financials, and to be perfectly honest, it's nothing really special. Revenue is up 4% year over year, reaching $1.6 billion, and the bottom line was up 66%. But it still ended at a $29 million loss. Now, if you'd only been given that information, you might think that it's not a terrible result, right? Well, Q2 financials came with a nasty surprise. Namely, revenue guidance for Q3 is now $800 to $875 million. To put that into perspective, Q3 of 2024 came in at $1.5 billion in revenue. So if it's true, they're expecting a 44% cut at the midpoint. And that's just not a bump in the road. That's slamming into a brick wall at full speed. Even worse, the company has never reported a profitable quarter. So that poor guidance erases any hope that it'll be profitable in Q3. But maybe there is a silver lining somewhere else. Well, its cash flow statement didn't necessarily incite much excitement either, other than the positive other working capital line item that led to positive free cash flow. But that's likely a reflection of Opendoor's high inventory turnover and operational dynamics. And we've seen that fluctuate a few times in the past 5 years, so it's not necessarily a positive indicator for the company's cash management. Then there's its 3.3 debt equity ratio, which means for every dollar of equity, Opendoor carries $3.31 of debt. It also has a 0.36 price to sales ratio, which in usual circumstances marks the stock as cheap. However, with Q3's guidance being low on the revenue side and still no profitability in sight, that 0.36, well, might as well be printed on a red flag. Still, there are some positives. Opendoor has consistently beaten analyst expectations for the past 4 quarters. Of course, maybe those expectations are very, very low at this point. And of course, analysts are also expecting that companies' net losses may shrink in the next 2 years. Its operating expenses are also on a downward trajectory, thanks to its aggressive cost-cutting measures, with Q2 reporting a 65% improvement from $402 million to $141 million. And finally, it reached adjusted EBITDA profitability this quarter. So yes, there are some bright spots, but they're more like flashlights in a storm rather than the sunrise. But to be perfectly honest, these positives don't support the stock's massive price boost. Now, if you're looking for reasons to be optimistic, here's where you might find one. So the housing market is expected to remain largely frozen in 2025, according to JP Morgan. Mortgage rates are high, inventory is low, and materials are getting more expensive. Now, there's really no indication that this is going to change anytime soon. But should things get better, Opendoor may see increased transaction volume, which could potentially expand gross profits per home sold and overall margin. Next, we have to remember that Opendoor is using its own proprietary algorithm for pricing models, on-site inspections, and renovation decisions. So any improvement in that front may have positive impact on its path to profitability. Lastly, and this is more of a speculative assessment on my part, is Opendoor's potential appeal to newer generations. Its all-digital platform fits the always online zeitgeist, right? So younger, more tech-savvy generations like millennials and Gen Zs could gravitate towards the platform. I mean, click to sell and click to buy with no need to meet anyone in person? Well, that's practically designed for the upcoming home buying generation, at least I think. And if that trend catches on, Opendoor could one day become the Amazon of real estate for the next wave of buyers. Of course, the flip side of this story is just as important, and these are the storms that Opendoor has to sail through. Now, in terms of headwinds, well, I've covered most of them earlier. Higher mortgage rates, more expensive materials, and unfavorable macroeconomic conditions, combined with his status as a pre-income company with no solid path to profitability yet, all work against it. The iBuying model also has thin gross margins. Even non-GAAP adjustments barely make any difference in the overall numbers. At the end of the day, I am a conservative investor. While it's fascinating to watch meme stocks soar to sky-high prices like fireworks, I'll be doing so on the sidelines for this one. That way, I won't be anywhere near the stock when it explodes and then comes crashing down back to earth. So I'm reading Opendoor a sell. I just don't see how its fundamentals and prospects justify its current price. And if history has taught me anything, it's that hype burns fast, but losses, they can last for years. But what do you think about Opendoor? Do you think it has what it takes to move up in the future, or is it going to continue to move lower? Let me know in the comments below. And while you're there, if you found this video helpful, don't forget to like and subscribe. It'll help others find it as well. Thank you so much for watching, and I'll see you next time.